In a Capital Decoded exclusive today, we cover the market consolidation wave across big tech and big industry as yet another media giant just folded inward. Paramount has submitted proposed merging with Skydance, laying off hundreds in the process. And if you think that's just a Hollywood headline, you've missed the bigger story. This isn't about entertainment. This is about consolidation and how it's restructuring capitalism itself. Let's go to George for more.
We're in the middle of a silent economic quake. Paramount is folding into Skydance, again, cutting another 3.5% of its U.S. workforce. That's hundreds of jobs gone, on top of 15% headcount reductions over the past year. Thousands are gone in 2 years flat. But it's bigger than one merger. 5 major media companies now control 90% of what Americans watch and read. In finance, the top 5 firms manage over $20 trillion in assets. In tech, 80% of online ad revenue goes to just 2 companies. Across sectors, large firms employ over a third of the U.S. workforce, up from under 30% 4 decades ago. What does this mean for workers? When concentration increases by 10%, wages fall about 0.3% on average. That doesn't sound like much until you multiply it by millions of workers year after year. That's persistent wage suppression, slower consumer spending, and weaker GDP growth. Paramount's debt load, now nearly $28 billion, adds even more pressure. With cable revenues down over 11% and operating losses in the billions, cost-cutting is baked into their strategy. That's why mergers now trigger layoffs as a first response, not a last resort. Consolidation isn't just efficiency, it's fragility. When one of the big 5 in media, tech, or banking fails, entire industries feel the shock. Fewer employers mean less leverage for workers, fewer career options, and more power in the hands of a shrinking elite. And the market reaction? Wall Street celebrates, stocks pop, buybacks rise. Analysts praise synergy. But on Main Street, every layoff expands the talent funnel, suppresses local wages, and erodes disposable income. Combine that with AI and automation, and it gets worse. Tech sector jobs dropped by over 35,000 in recent years post-pandemic. Many haven't been replaced. AI is accelerating this pattern, eliminating roles, not creating alternatives, especially in mid-tier positions. This isn't capitalism evolving. It's capitalism weaponizing consolidation. It's turning economic systems into brittle ecosystems. Monopsony power grows. Worker leverage shrinks. Wages stagnate. Opportunities vanish. The only off-ramp? Decentralization. We need more antitrust enforcement focused not just on prices, but on labor market health. We need startup incentives, open standards, stronger union frameworks, and investment in regional hubs, not just coast-to-coast concentration. Because when a handful of firms own distribution, content, data, and jobs, we don't have competition. We have corporate hegemony. And that's when the system breaks. Because capital is cheap, but human capital is finite. If we don't rebalance, we'll end up with fewer employers, fewer dreams, fewer pathways. That's not resilience, that's breakdown, and it's happening now. This is Capital Decoded.
Thanks for watching. Don't forget to subscribe to our channel. This is Capital Decoded.